speaker number 2. The topic that we have today is, can human minds be programmed to be a rational investor? And to speak on this today, we have Mr. Aniruddha Sarkar, Chief Investment Officer, Quest Investment Advertisers, joining us. So, like I said, Mr. Aniruddha is the CIO and Portfolio Manager at Quest Investment Advisors. He brings with him over 14 years of experience in the capital markets, managing money for investors across PMS, AIF, and advisory business. Prior to joining Quest, he was with IIFL AMC for over 11 years, and he was the portfolio manager for IIFL Multicap PMS since its inception in the year 2014. It's truly an honor having you here with us, Mr. Aniruddha. A very, very warm welcome to you for the third summit. Thank you so much for joining us today. It's our pleasure.
Yeah, thank you, Shruti. A very warm welcome to all my investors. Yeah. So I'll just pick up from where Ashish he ended. In fact, he had an interesting quote at the end, which was speaking about how emotions are an important factor in all our investment decisions. So over the next half an hour, I would just like to take you all in an area which is a bit away from stocks and investments. We'll try to spend some time on how we actually behave in the markets with our money. And it's actually interesting to know that investors, they think differently about a single stock at the same price. And that's the reason we have the purchases happening. So let's get a bit deeper into how we actually handle our investments. The biggest problem with the human mind is that we are always fixated with the outcome of any decision. If the outcome is good, we believe the decision was good. If the outcome was bad, we believe the decision was wrong. But what we actually need to see is that when we had taken the decision, it could have been the best decision under those circumstances at that point of time. So this is something which is very close to my heart, and I keep telling my investors that emotional part of investing is very, very important, because that is something which we cannot learn, comes through experience. Now the topic is about the rational investor. It sounds very idealistic, but let's just try to understand who's a rational investor after all. A rational investor is basically one who takes into consideration all the available information around him to arrive at a decision which gives the best optimum outcome. I know it sounds very, very idealistic, but that's the way a rational investor should behave. This presentation, I'll try to break it up into two parts. The first part is something about the human brain. I know it's something away from investments, but let's try to understand it. The first part will be talking about the human brain, and the second part will be talking about how our emotions come into play. So this is one interesting stats, which I don't know how many of you know, is that over the last 1.5 lakh years of our evolution, the human brain has practically been stagnant. Now, to think of it, the same brain was being used by our ancestors for hunting, and the same brain is being used by us in today's world in all its complexities. And the most interesting part is that the same emotional centers of our brain, which was actually associated with fear, which ensured our ancestors were able to safeguard themselves against the attacks from animals, is actually the same portion which is being used as of now to analyze the information which is linked to the financial risk. It sounds very, very two different worlds, financial risk and animal attacks, but it is the same part of the brain. Now, this part of the brain was actually made for instant action, because when you're attacked by an animal, you cannot spend half an hour evaluating the whole situation. So this part of the brain was meant for instant action. And that is the reason, if you see in today's world, most of our investors are action happy. Very few investors you'll find have that patience and ability to spend time. That's why they say that most investors are willing to take an instant action. Now, this is one interesting slide in which these four words which are there on your screen, if you just have a look at these four words, in fact, this is something I asked some people around, that what is the common thing between these four? The drug addiction, equity trading, the gambling, or the binge eating? The common word which comes to mind is excitement. Now, that's a fact, because all these four activities actually stimulate the same part of the brain which releases the hormone dopamine, which is linked to excitement. Now, if you ask me that, don't we have any rational investors? The answer is no. There are rational investors. In fact, all of us are rational investors up to the point we incur a loss. Now, that is very interesting. You being a rational investor gets transformed from being a rational into an irrational investor at the point of incurring a loss. Now, what happens is that once we incur a loss as an investor, the pain centers of the brain, they get activated. And that is the time when all our future analysis and decisions, they become a bit irrational because the pain centers of the brain have been activated. Now, the most funniest part is it's actually an irony. It's an irony that when we incur a loss, we actually start taking much more riskier bets. On the contrary, what the logical sense says that if you have incurred a loss, you should play safe. On the other way around, what the human mind thinks is that since I've incurred a loss, I need to be a bit more active. I need to take slightly more risk in order to make up the loss. Now, this is another aspect of the human mind, which is how it shapes our behavior with the outside world and with our investments or anything else for that matter. So all these factors which I'm mentioning about the brain, this is not just linked to the investments. This is something which we all would be kind of experiencing with different aspects of life. But over here, I'll come to the investment part afterwards. Now, this slide, it basically shows that all our behavior is linked to a large extent to our initial experiences and to the most recent experiences. I'll give an example. Now, when I say about the most initial experiences, what it basically means is that people who were, I'll give an example, which means that people who were born during the depression of 1929 to 1940, people who were born during subsequent recessions, it has been found that they are extremely averse to risk. Their appetite for risk is extremely low, and that is because they had their initial experiences in life, which was a bit negative. On the contrary, we have seen people who were born during the late 90s or during the subsequent rallies in the market. They are extremely high risk takers, and that is something which is inherent in them. Now, if you come to the most recent example, which is there, now the other part, so this is the initial effect. The second part is the most recent experience. Now, it is a very known fact that once we incur a loss because the market has shown a sharp fall, we become extremely pessimistic in the market. Now, the most recent experience in the month of March is a good example. After seeing the fall in the month of March, what we saw is that people were averse to taking exposure in equity in the month of April, May, June, July, all the way till August, September. Now, that is something which highlights the significance of the recency effect. Now, question comes, so what's the solution of that? The solution lies in the fact that our own personal life experiences are very short. We have our experiences of the last 15 years, 20 years, 30 years, but we should take some kind of experience from the market history, which is 150-year-old market in the US, which is a good example how the economic cycles happen, how the bull markets, the bear markets happen. So we should not just take the short-term experiences or our initial experiences into account while taking the investment calls. Now, in this slide, what I'm trying to show is that, and this is a fact, it's not just about investments, it's about anything in our life. Anticipation of a reward is actually more exciting than actually receiving the reward. Now, what happens is that, when you actually receive the reward, the whole fun of waiting for that reward is gone. That is a very big reason why most investors, they fail to book profits. Now, the whole idea of entering into an investment was to make profits. Once you see profits happening, you get excited. But the human mind is by default structured to be unsatisfied, and it keeps on anticipating a higher profit. And that's the point of time wherein we make the biggest mistakes, wherein we have not taken a profit off the table. Another reason for, I would say the unsatisfaction of the mind is the human mind continuously seeking the relative outperformance compared to others. And I think the investment world is the best place where you can have this. People, investors, fund managers, portfolio managers, we all strive to outperform everyone else. And I think that is one big reason of the human mind being unsatisfied. Coming to one important aspect of investment, which is the risk analysis. Now, interestingly, you ask any investor at what point of time is the highest risk in the market? Is it in the times when the markets are over optimistic, or is it in the time when the markets are over pessimistic? The answer in majority of the times we get is the risk in the market was the highest in the month of March in this year. And in the years and in the period, say December, Jan, Feb, the risk was not so high. On the contrary, the fact of the matter is that the highest risk starts building up during the times when there is over optimism in the market. It's only during the bear market when the manifestation and this unfolding of the risk is evident in the equity prices. But the risk built up was the highest actually during the times when the markets was good, because at that time what happens is investors are happy to bid the prices higher and higher without taking into account the fact that what valuation they are paying for the prices at which they are picking up the companies. So the risk buildup happens the highest during the phases of optimism. Now, I'm sure all of us, we follow football as a game, and one thing which we all know that football matches are not won just by scoring goals. A big part of winning a game is how many goals you are able to save at your end. So safeguarding of the goals is a big part of winning the game. Coming to investments, definitely having an excellent year, building up supernormal returns is very good, but the real wealth creation happens when you're able to ensure the risk management of that wealth which has been built up. So risk management is one of the big factors which drives the equity returns in the long run. Unfortunately, when we talk to investors, hardly anyone talks about risk. Everyone talks about the returns. They begin with what was the past return, what is the expected return, and what is the expected return in individual companies. But nobody talks about what risk you're going to take to give me that returns. So risk management is very important. And when we have seen or attended different workshops on risk management, we have all seen these typical risk: systematic risk, which is the market risk; unsystematic risk, which refers to the company specific risk; concentration risk, the liquidity risk, and there are n number of risk. One risk which hardly ever anyone talks about is your emotional risk. Now, the fact remains that we don't talk about emotional risk because that is inside us. Very difficult to analyze something which is inside you. The next couple of slides, I'll try to take you through this part of the risk, which is the emotional risk and how we should handle that. Confirmation bias is the first part which I will want to mention. Now, what this means is that when we have a view on a company, we start looking for information which is going to support our view. Now, this is something which is very harmful because we ignore the other facts and figures and we look for only the news which is going to support our view. Now, the question comes, how do you handle it? Now, we follow a very simple style of how to take care of this confirmation bias at Quest. Now, what we do is we use a style called we need to destroy the idea, which means any new company idea which comes to us from the investment team or anybody, we try to see what can go wrong with the company. In fact, when I talk to my analysts, the first thing I say is that what can go wrong in the company. So we try to see what can harm the company. Say an economy which is shut down for 6 months, interest rates shooting up, inflation shooting up, the raw material prices shooting up. So what can go wrong in the company? And how will that impact the company? If after all these kind of, trying to destroy that idea, if a company is able to pass through it, then that's definitely a sure shot confirmation that you have got a good idea for your portfolio. And that takes care of a big part of the confirmation bias which is there in the market. The next bias is, I think all of us have seen it every day. And this is something I think investors and short-term traders, the long-term traders, the long-term investors, they all see it every day, which is your anchoring bias. Now, this is one of the most common biases which we have. So I'll give an example. Now, what this bias means is that we are fixated to a price. Now, if you would have suppose you have bought a stock at 100 rupees, the stock, and you had bought it with a view that I want to sell it at around, say, at 150. Suppose the stock goes to 160, 170. You are happy that you are willing to sell it at 150. The stock is at 160, 170 now. Subsequent to that, suppose it goes to 180 or higher. Post that, suppose it comes down to 160. Then you get fixated with that higher 180 price, which means you are not able to sell it because you have seen a higher price. Though you had initially entered with a view that you want to sell it at 150. Now that is an anchoring bias. Now that 180 has become like an anchor for you and you do not want to sell at the price below that. The other part is about entering into a stock. Now, suppose you have analyzed a company and you see the current price is very high, say at 100 rupees. Suppose the stock comes down to 80 rupees, you start feeling that you are getting the stock cheap. It was at 100, it has come down to 80, so you're getting it at 80 bucks. And that 100 becomes a anchor. You miss out on the fact that you have not evaluated what is the valuation of the company at 80. Was that 100 rupees the right price? Is 80 rupees the right price? Should it be bought at 60? So that 80 becomes attractive for you because you have seen 100. So this is called an anchoring bias. Now, how to take care of it? Just be away from the price. Don't base your investment decisions seeing the market price. Market price is something which changes every day. So we cannot base our decisions on the market price. So what we do is we try to analyze the company as it is on a standalone basis. We try to evaluate it with all the factors and parameters into consideration. And then if it makes worthy for being an investment portfolio stock, that's the point of time we try to have that in our portfolio. So avoid taking your decisions just based on the price of the stock. The next bias which we all see is information bias. Now, this is something which is slightly linked to the first bias which I had mentioned, which was the confirmation bias, but slightly different in the sense that in information bias, what we do is once we own something or once we want to buy something, we keep on trying to analyze every small information on that company. Now, what this leads to is the paralysis of analysis. Now, that's what we say, analysis paralysis or paralysis analysis, wherein you start taking into account every small information about the company, which could be or could not be important in taking a call on that particular company. Information bias actually starts making you feel very overconfident. You start feeling overconfident that you know everything about the company, but the fact is that your mind has now become too much into the company, and you will actually ignore any negative news or the negative view on the company. So that is something which you need to actually completely avoid. What again, this you can try to protect yourself from the information bias is by avoiding seeing the daily prices and the daily news on a company, because every day with the social media and with so many business channels, there is n number of the news which is floating around the companies which you own or which you want to buy, and that's the point of time wherein you will start getting too overconfident on the particular company. This one is very important in the sense that I know all of them are important, but this one is particularly important because this actually induces us to think in a very different way than we would have otherwise thought. Now, this is a fact, which you're seeing on the right. This image is actually a fact that the pain from losing an X amount is actually 2 times more than the pleasure of making that same X amount, which means the joys of making 1,000 rupees is actually half of the pain which you would have suffered if you would have incurred a loss of 1,000 rupees. Now, because of this, what happens is people hesitate to book losses in their investments. And that is a problem you would have seen even in your personal portfolios or in any other portfolios. When you have investments which are in loss, people hesitate to book losses. And in the process, what happens is they forego the opportunity cost of being into some other company at that same point of time. Now, how do we take care of that? Now, this is something, again, I have been always saying this to my analyst team and in my investment community. If any news comes on any company, we try to evaluate that news as if we don't own that stock at all. Because the problem is the moment you own that stock, your mind starts thinking in a very different way. So we try to evaluate that news on a particular company as if we don't own that stock. Then we come to the conclusion that will we buy this stock today if we did not own that stock? Now, if the answer comes no, then definitely the answer is we need to book a loss and exit from your portfolio. If the answer is yes, then you are okay to hold on to that stock. By doing this small check on your portfolio, you take care of a big part of the loss aversion, which typically inflates our mind. Now, this is something which is very understood. It's self-explanatory, and the herd mentality is actually the founding stones of the big bubbles which are formed, whether it's the IT boom or the IT bubble or any other bubble which is there. This is basically the herd mentality behind it. How to tackle it? Simple. You just need to avoid the consensus trades. If everyone on the street or everyone on your WhatsApp group is saying that we should buy this, then definitely that is something you should not buy at all. It's better to underperform in the short run, but the real wealth is definitely built in the long run. So herd mentality is something which you need to avoid. The recency bias is again something which I mentioned in my earlier slide about the most recent events which happen, that actually influences your mind, and that actually kind of influences how you are going to act upon the market. Now, a good example was in the month of March. As Ashish also just mentioned in his earlier presentation, the portfolio returns in the month of March, April, the 4 years, 5 years annualized returns will be very, very different compared to what it is now. So definitely people, after a big fall in the market, they see the most recent fall or the most recent underperformance of a portfolio, and then they base their whole decision on that. Now, how to take care of it? Again, you need to stay grounded on fundamentals. You don't let the price and the most recent corrections impact your decisions, which you would have taken, in a different set of mind, taking into consideration all the different parameters with regard to the fundamentals of the company, and you should not get biased with the recent events in the market. Sunk cost fallacy is something, especially this is seen more in the investment world, wherein if you would have spent enough time, enough money into researching a company, investing into a company, post that you feel that if you don't invest or if you don't continue to hold into that stock, it's a big loss for you, which means a cost has been incurred in kind of building up the whole investment rationale, and at that point of time you don't want to allow it to go. So the question you need to ask yourself is that, will I or would I have invested into this company had I not spent so much time and money into it? If the answer is yes, then definitely you need to be in it. If the answer is no, then we should be out of it. And this is the last one which I want to mention, is about the gambler's fallacy. And this is a very, very common thing which you can actually practice around you. If you flip your coin 4 times and you get a head each time, you ask someone who's standing next to you that what are the chances of having a head or a tail the next time. The chances are he'll say you are most likely to have a tail, because he feels that since you had 4 heads in one go, the next one is going to be a tail. But the fact of the matter is that the past outcome had no influence on the future outcome, which means that you can't leave your investments to luck. There are many things which in the past impacts your present and the future, but on a whole, typically it is evident that the past does not impact most of your future outcomes. So we need to evaluate each investment independently, as if the past occurrence is not going to influence the future. So broadly, what we try to suggest to investors, and this is something which we also practice at Quest, and this is something which is very, very important, is that you need to make your plan during the times when the things are peaceful. And this is actually a practice in the army, that you need to make your plans for the war when things are normal. So what this means is that you keep your watch list of companies ready. You keep the prices at which you would be comfortable to pick them up. And when the things turn bad, when the markets turn tight, you need to stick to your plan. Don't change your plans during the times when the things are bad, because you have spent enough time, analysis, both fundamental and everything, to figure out that these are the prices at which I'll be comfortable to enter. So when the panic hits, you need to act on that plan. And one thing very important is avoid taking decisions when there is stress and the temperaments are high, because history shows that the worst decisions are actually made during the times of the stress. So this is a good summary of all the things which we have just discussed, and I think I'm on time. And so broadly, I think we'll be sharing this presentation also with all our investors, and I think this should be giving a good kind of summary to whatever we have just discussed.
Thank you so much, sir.
You're welcome.